Yeah, so Guy, talk to me a little bit about your thoughts on Apple stock here. It's almost unchanged on the year. Fundamentally, what's your take?
Well, I mean, she outlines it really well. And when you have a vast percentage of the world population as part of your install base, you obviously are playing from a position of strength, number one. When you have $250 billion sitting around on a pristine balance sheet, you're playing from strength too. When you have services revenue, which now represent 21, 22% of overall revenue, you're playing from strength. And when you have a stock that people run to in times of distress and in times when the market appears to be going lower or under pressure, you're playing from strength. That's the bull case for Apple. And quite frankly, it's played out really well over the years, other than a 5 or 6 or 7 times where you've seen meaningful, Dan. And when I say meaningful, 25 to 40% peak to trough declines. And I think Carter's about to tell you that we're on the precipice of exactly something like that.
Well, so let's start with let's start with the former, and then we'll go to yours truly. So we know what there are about 50 analysts that cover the stock, and the high on the street is up at around 220, 230, and you've got people who think it's this is 12 months hence, right? And you got people that think it's worth $1.40. Let's say Goldman Sachs. It's a sort of a well-known firm. Credit Suisse, well known in there. Now, Goldman Sachs thinks it's worth 12 months hence 140, so the stock will be lower. And this is why this is important for all of us. This is why you got to put away the fundamentals. So, I mean, these are very qualified people, highly educated, highly certified, which means they have MBAs or CFAs or CPAs. And then they took all that and they studied Apple, which means they studied hardware and they studied consumer spending. They studied, trends in apps and whatever. And this phone versus that phone, and Androids. And how? How is it possible that one man and one woman could come up with 12 months hence, I think it's worth 140. And on the other side of the table, no, I think it's worth 201, 210. How is that possible?
Of course, it's not possible,
It's
but you
not
brought
possible.
some charts to illustrate why it doesn't matter what they think. It really
Correct.
matters what the
Correct.
charts look like.
That's right. So let's look at some charts. And charts are not infallible, but they've got as good a shot as any other method of getting you to the answer. The first of several, this is a comparative chart. And what do we know? It's year to date. And we know that, of course, the market's down and Apple is up, and the spread is, very wide. Look at the next, which is a one-year chart, and it's the same thing, but the spread here too. You've got the market down 10% and Apple up 15. That's a lot of spread. Let's keep going. Look at the next comparative chart. Now you're looking at a 3-year where the market is up 75% and Apple's up 240. Let's go a little further. Let's look at the 5-year. And these are to the Qs, right? When I say the market, I'm saying its brethren, the Qs. This is a 5-year chart. Again, you're seeing more than a double Apple versus, now there's autocorrelation. Apple's a part of the Qs, of course, but then finally look at an Apple chart itself, and then let's try to discuss it. You can call it a megaphone, you can call it whatever you want. What we know is this: the stock has up 35% from its June low. Market bottomed in June, mid-June, so did Apple. And Apple, just, even if you're not a chartist, the angle of the line or the lack of variation, there's no drawdowns, no givebacks. It's just tick, 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 higher, each day higher. It's unnatural. And so whether you do it through an option strategy or whether you just trim your long because you have a lot of it, or you with new money go short, just sitting here and riding long and saying, hey, off we go, it's not good technique,
Yeah.
as I know it.
Well, here's the thing, Carter. You and I did options action together for 10 years on CNBC, and I love your work, because to me, I spend a lot of time toiling away at the fundamentals and thinking about sentiment and thinking about a lot of things. But I also have a little, I don't know, little history with options trading. And so the whole idea of kind of defining your risk. So I've keyed a lot of trades over my career off your technical take here. And when I saw this email come in from Worth Charting today, I was looking for a reason reason to get short Apple, and that was enough for me. So I did it through options, and I just want to walk through a trade idea that I had today, that I executed earlier today. When Apple was trading around 174, I bought the September 16th expiration 170 puts. I paid about $3 for those. Those break even below 167. I have losses of up to $3 between 167 and 170 with a max loss of $3 above 170. What I really like about this trade idea right now is that option prices are cheap. I am risking about 2% of the stock price with a 4% lower break even. And really, when you think about what is the price of options here, we have a chart of implied volatility, okay? So the price of short dated options versus its historical volatility, okay? When you look at this chart here and you see how at about 24% implied vol, which lines up with the historical vol, that says to me, expressing directional views, long premium in options looks very attractive here. And I just want to make one other point, how I'd manage this trade. I like to use a 50% mental stop of the premium I paid. In this case, I paid $3 for that put option. If that put option was only worth about $1.50 because the stock kept going higher or went nowhere and the option started to decay kind of quickly here, and it will decay kind of quickly, this is a short dated option, then I'm going to look to cut my losses. I don't like seeing long premium option trades go to zero. That being said, if I look at my chart here and I've lined them up with Carter's lines here, if I get a break of that very, very steep uptrend and I have a target of about 160, that's that 200-day moving average, that would be my first target. I'm going to look to either roll these puts down and out or maybe spread them by selling a lower strike put, making a put vertical spread here. That's my trade on your technical view, Carter, and your fundamental view there, Guy.